Good day, students who are very lovely. I'm recording this video out of love. So if you're listening to this video, know that I love you too, even if you're a gentleman. Now, question one, under the additional questions, this question is on the financial statements. And as usual, it is my norm before I record sometimes that I start looking at what is required first. Now, we are required in this question to calculate the total comprehensive income or a loss of Moon Traders for the year that ended 31st of March 2005. The second and the last requirement is to prepare the statement of financial position of Moon Traders at the end of the same accounting period, which is 31st of March 2005. And if you look at the marks, the total, it is 28 marks, and we speak of 28% in the paper that is out of 100 marks. So this is 28% of the paper that you need to make sure that you understand completely. Now, the minute you read the question and you discover that you are required to prepare these two, sometimes you will be required to prepare the statement of changes in equity somewhere there, maybe A1. They'll normally say prepare the statement of changes in equity for the year ended 31st of March. Now, we are not required to prepare the statement, but we are to show the calculations of the statement under the statement of financial position. So we must do the workings of the statement of equity under the statement of financial position under the line item called equity or capital. Then there's something that I did not emphasize, though it was not much important in the previous video that I recorded and on the preparation of the financial statements. The other question that I did, that question was based on another inventory system which is called perpetual inventory system. Now, this is not either perpetual or periodic, but this is a service entity, and it's very important to be able to distinguish between the three income statements that you can be asked. I will do another one probably before the end of next week. Now, that one will be based on the periodic inventory system, where we must calculate cost of sales by our own selves. But this one is a service entity. Now, a service business is a business that does not buy and sell goods and services, but it's a business that renders its services to its client or tenant. Now, you could be repairing televisions, you could be repairing cell phones, that is rendering of the service. You could be a maintenance company, that is rendering of the service. You could be a company that receives money through rental, that is the rendering of the service. Now, a rendering of the service business does not have cost of sales when we do income statement. So now that means in such type of businesses, when we do the statement of comprehensive income, meaning when we respond here, you will not see us saying cost of sales. We'll just have to say income if it's income, whatever income the business is making, or commission income, or rental income if it's rental income. We say income, and after we say less expenses. In this case, there will be no cost of sales, because we don't buy a product at a cost and sell the product. So there is no cost of what we are selling, but we only have incomes and expenses. Why so? Because we are not a trading entity. That means we don't buy and sell goods and services, but we make money through the rendering of the service. So that is why now the income statement in this question will be slightly different than other income statements that I've done, and the one that I will be doing when the business is using a periodic inventory system, where we must calculate cost of sales by our own selves. Now, we know what is required, and I've given you the brief that this is a service entity. Now we have to draft first of all what we call the skeleton of the statements, meaning income statement and the statement of financial position. So now we start by saying a statement of comprehensive income. I use the abbreviations, guys, but please write everything for the sake of the exam. Then I'll have my incomes here. Then I need to check now which incomes do I have. Remember, if this business was using perpetual inventory system or periodic inventory system, meaning if this business was a trading entity that uses either perpetual or periodic, and I'm not going to explain further on the perpetual now and the periodic because that's not my focus. If the business was a trading entity, then we were going to say here sales, then after cost of sales. But this business is not a trading entity. That means it does not buy and sell goods and services. And again, another question is popping up and says, how do I know that from the provided information? If you look at the pre-adjustment trial balance at the end of the current accounting period, the pre-adjustment trial balance of Moon Traders, the fact that it says traders, it does not mean we are buying and selling goods and services. In the pre-adjustment trial balance, we can see that there is no item that says sales. There is no transaction that says sales or account that says sales. We see rent income, stationary capital, drawings. You look down, we have, is there any other income? There is commission income and credit losses and all other accounts, but we don't see sales. The minute we don't see sales, then we can be confident that this business is making money either through rental or through commission. So we don't know so far which one is their main income and which one is their secondary income. So we can see from the trial balance that this company is really a service entity. So now let us then continue with the income statement. And other incomes, we have seen already that we have rent income. And under rent income, and I always say open brackets, guys, we are still doing the skeleton. Rent income, it is 64,000. And I want to highlight also in this trial balance that we only have one column, and you must know, guys, when or where does the account get to be recorded. In this case, we know that incomes increase on the credit side, so that is on the credit side. And the minute is one column trial balance, it can be tricky sometimes. And I think I have to show you, or I don't know how I can send it, because I do have material that I would like to send it to you that will show you which accounts increase on which side. Are they assets or liabilities? Are they current or non-current? But I'm not focusing there. We do have income of 64,000. Then there's also commission income that amount to 27,000 rands. Now we have 64,000 rands. Remember, I'm still doing the rough draft of what is provided first. Then we have commission income. Then our commission income, it is 27,000 rands. Why I'm not writing this under total? Because I know that there is still what is called additional information, which is called sometimes adjustments. So additional information, we will be adjusting these amounts, the ones that are affected by the adjustments. So at this point in time, I don't write the amounts under total because I expect that there might be adjustments that are coming. So I might plus here, I might plus here, I might minus, I don't know. But I'm just writing what is given in the trial balance. Then after I say less expenses, remember this business is a service entity, less expenses. Then I look at all the expenses. Now it's very important that you must know which accounts are expenses. And once again, I do have notes that can show you some of the examples of the expenses. Stationery of 3,350. Stationery of 3,350. Stationery 3,350. I will still explain stationery very well because there is a necessity to explain the account of stationery. Then after we have done this one, we have taken stationery. Then we look for other expenses. Remember, this goes to the statement of changes in equity. And this goes to the statement of changes in equity. Capital and drawings, they go to the equity. This is property, plant, and equipment item. I'm still looking for expenses so far. We have credit losses. Credit losses. Remember, credit losses are what we call bad debts. A debt that is not paying his account. Property, that is property, plant, and equipment item. This is also property, plant, and equipment, which is the statement of financial position. Bank, this is also under statement of financial position. Trade receivables, interest on mortgage loan. Interest on mortgage loan. We record it here. Interest on loan, which is mortgage loan. Credit loss, I forgot to write the amount. Credit loss is an expense 1,600 rands. Interest on the mortgage loan. Let us look at the interest. Remember, this interest is interest that was already paid, 23,870. 23,870. This is already paid. And I always say this, expenses that we see in the trial balance are the expenses already paid, and incomes are the incomes already received. So now that means the income that we see, the rental income here is the rent that we have already received, but it does not mean this is what we're supposed to have received. And again, except stationery. Stationery is what we have already paid, 3,350. But credit loss, we don't pay a loss, we just write it off. And another one was commission income. The commission of 27,000 is the income that we have already received. But the question is, were we supposed to receive this amount for the full year? And were we supposed to receive this amount for the full year? The answer will come from the adjustments, if there is an adjustment. If there is no adjustment, that means this income is what you're supposed to have received, and also this income is what you're supposed to have received. And again, we have another expense. Which one? I'm looking for the expenses now. Interest on the mortgage loan. We paid this interest already, and I say expenses that we see in the trial balance are the expenses already paid. We paid this expense, but were we supposed to pay this expense, or did we overpay or underpay this expense? We don't know yet, but the adjustment will tell us. If there's no adjustment, that means this amount is correct, is what was supposed to be paid, therefore we'll write that under total. But if there is an amount here that was not supposed to be paid, or an amount that was supposed to be paid but it's not here, therefore now we need to make an adjustment that from the adjustments. We have municipal tax, which is 4,333. Municipal tax. And the municipal tax, it is an amount of 4,000 or 3. Let us check the municipal tax. How much is it? Municipal tax 4,333. Municipal tax 4,333. It is 4,333. Then that is the municipal tax that is paid. Insurance, we have paid this amount already. This is what we have paid, but it does not mean this is what we're supposed to have paid, unless there is no adjustment concerning that. 2,405. That is the insurance we have paid already. Insurance, we said insurance, it is 2,405. Then we go to the next one, and it is mortgage. This is a liability. Go to the statement of financial position. We have water and electricity, 2,750. Water and electricity, water plus electricity, and the amount of water and electricity, it is 2,750. Yes, 2,750. 2,750. There is another expense that you must always make provision for it. Even if it's not in the trial balance, make a provision for depreciation because it is likely to be there. Then from here now, these are the expenses that we have. Then we will adjust them from the adjustments. Then now we do the next statement, which is the statement of financial position, which we know the statement starts with assets, and under our assets we have non-current assets. Under non-current assets we have property, plant and equipment. I think now you know the abbreviation PPE, property, plant and equipment. And vehicles, I always want to mention that we record the cost and the accumulated depreciation. Let us start with the property, and the value of the property is 350,000 rands. We have property, we say 350,000 rands. Let us look for another asset, and I think there was equipment somewhere. Yes, the equipment at the cost of how much? 34,000 rands. That is our equipment, 34,000 rands. Then we record the 34,000 rands of the equipment. We minus the accumulated depreciation that is given to us. We do have accumulated depreciation on equipment. There is the accumulated depreciation on equipment, and this accumulated depreciation is likely to be at the beginning of the year. It is 15,000 rands minus 15,000 rands. That will be accumulated depreciation on equipment, 15,000 rands. And just to verify, the cost of the equipment is 34,000 rands. Then we have accounted for the property, plant and equipment items. We don't have a motor vehicle, we don't have a plant, so we stop there. And there is no fixed deposit. Fixed deposit, remember, is a non-current asset. Then we go to current assets. Under current assets we have the first asset, and that first asset under current asset is called inventories. Is called inventories. And under inventory we need to look for the amount of the inventory that we have, but there is no inventory in the total balance. But the stationery sometimes can be inventory, but let us leave it there. But don't ever record stationery from the total balance as inventory. Then there is no other item of inventory. That means they might tell us how much is the cost of stationery at the end of the year, because this is the stationery that was bought during the year. And remember, after we bought this stationery, we used it during the year. So now as we are using it, it becomes an expense, which is stationery used. So now hence it becomes sometimes very important in the income statement to be very clear in terms of stationery and say stationery used 3,350. Stationery used, which is 3,350, because we want to know how much stationery was used. This stationery is the one that was purchased during the year. Then we need to know how much was used or how much was left, so that we can calculate how much stationery was used. Then we go to the current assets. We are still waiting for the inventory from the adjustments. Then we record what is called trade and other receivables. We will have trade and other receivables. Trade and other receivables. And we know that trade and other receivables are what we call debtors. Debtors, trade and other receivables. Let us look at the trade receivables. There we do have the amount of trade receivables. Trade receivables control. It is 26,100 rands. This is 26,100 rands. There will be other accruals and prepayments that will be provided. Then now we go to our bank. We go to the bank account. Then we look for the amount of the bank in the trial balance. They said that bank has a favorable balance, and the minute the balance of the bank is favorable, that means it is on the debit side. 24,208. 24,208. 24,208. Remember, if the bank balance was unfavorable, that will mean that this bank balance will be recorded under current liabilities, not under current assets. Then after we know that from here it will then be what we call equity and liabilities. But let us first write our total assets. Our total assets. Then we go to equity and liabilities. Let me just change the color. Then we go to equity and liabilities, where we start with the equity first. Then we start with equity. Under equity, we'll have what is called capital. Now here under capital, that is where now we are recording the statement of changes in equity here. Now under the statement of changes in equity, what do we record? We record the capital opening balance of 149,000 rands. Capital opening balance of 149,000 rands. Then after we minus drawings, if we do have drawings in the trial balance, there we do have drawings, amount that was taken by the owner for personal use, 6,084. We say minus 6,084. Then there is nothing else to be recorded. Then we await the adjustments now. Remember, after this is done, remember we know that we will get here to the profit for the period. We'll get profit for the year here in the income statement. Remember, this is the income statement. In the profit, in the income statement, we'll get profit for the year. And when we get the profit for the year, the amount of the profit for the year that we get here is the one that will be transferred. This amount will be transferred straight under equity in the statement of financial position. We'll have to say plus if it's a profit, minus if it's a loss. I want to highlight that. It's a plus if it's a profit or minus if it's a loss. Then after we have non-current liabilities. Non-current liabilities. Under non-current liabilities, I think we did have a long-term borrowing or long-term loan. Long-term borrowing or long-term borrowings. That means everything that is long-term must be recorded here. Under long-term borrowings, we do have mortgage loan, and it is 248,000. It is 248,000 rands. This is the first step, guys, whenever you do financial statements. Then after this is done, which is the mortgage borrowing, then we go straight to current liabilities. We go to current liabilities. Under current liabilities, we have trade and other payables. We have trade and other payables. Trade and other payables. Then we need to look for trade payables control. Trade payables control. Do we have any trade payables control? We have trade receivables control. We don't have trade payables control. Why there is no trade payables control? It's because this business does not buy something from their supplier. So they don't owe any supplier anything because it's a service entity. Remember, all they do is to render a service to their clients, which we think in this case it might be rental, and if it's rental, there's nothing to buy from the supplier and sell it. So we don't owe suppliers, hence trade payables are not here. So that's not a transmesh, but there might be things that need to be recorded under trade payables. Now guys, immediately you verify that all the amounts have been recorded, and I know that I've captured all the amounts. The 1.6 was for credit losses. Let me just verify, I don't remember that one. We had credit losses of 1.6 years. So you make sure that you verify that all your amounts have been recorded. Yes, 261,000, 26,100. This was trade receivables. Yes, interest, municipal tax. Make sure that as you are recording these amounts, you tick them, you mark them. The minute you are done recording all these in your financial statements, then you know that minus almost 50% of the workload. Therefore, now what do? You go straight to the adjustments. Statement of financial position. This is as at 31st of March 2005. It was 2005. Then you go to your adjustments. Remember, you are not required to do adjustments. But why do we do adjustments? Is because adjustments will help us to record very accurately. That is why we do the adjustments. They are not a requirement to this question, but it is very useful workings in response to the financial statements if adjustments are provided, and adjustments will always be provided, that I can assure you. Now you draw your adjustments, your general journal, where you'll be doing the adjustments. Now these are your workings. These are your workings plus other working that I'll be using. So now we go straight to the adjustments. We no longer worry about what is above unless necessary. We do all the adjustments up to 1.8. After 1.8, we are done and dusted. We balance our financial statements, and surely they should balance. Now we start with the first adjustment. The first adjustment is telling us that Moon Traders had 5 tenants. Okay, we can see that this business is in the man is in the business of rental. Had 5 tenants, each paying different rental amounts. Maybe they stay in different places, or they stay in one place. I don't know why they will pay different amounts. At the end of March 2005, one of Moon Traders' tenants owed how much? He owed 2 months rental to the enterprise. He owed 2 months rental to the enterprise. Now, if he owed 2 months rental to the enterprise, it means he is supposed to receive the amount, but the tenant did not pay the rent for 2 months to the enterprise. The monthly rental payable by the tenant, it is 1,750. Take note, the monthly rental payable by the tenant is 1,750. So this tenant is renting 1,750, but he owes the amount for 2 months. Therefore, now this must be multiplied by 2. Remember, anything that is not yet paid from the tenant point of view, meaning money that we have not received in this case, because we're supposed to receive the amount of 1,750 for 2 months. We have not received it. So now what do? We say 1,750 times by 2. This amount is not yet received. So now in other words, 3,500 is not received yet. That means it is accrued. It is accrued income. Income not yet received. What do we call? Remember, I recorded a video on this, on the accruals. That video is very important because it unpacks all these things, all these accrual bases. Now 3,500 is not yet received, meaning it is accrued rent. Now the question is, were we supposed to receive this 3.5 during the current period? The answer is yes, because this 3.5 belongs in the year 2005, that end 31st of March, but we have not received it. What does that mean? That means the rental amount that we see in the total balance of 64,000, this amount, That means this rental amount of 64,000 is underestimated. It is less than what you're supposed to have received. We're supposed to have received 64,000 plus 3,500. That means that 64,000 must be increased by the amount of 3,500. So now how do we increase income? Incomes increase on the credit side. So we say rent income. That means we are saying now our rent must increase by 3,500 because 3.5 was supposed to be received. So now anything that is supposed to be received must be recorded in the income statement, because accrual basis is teaching us that we must record incomes that we supposed to receive, not incomes that were actually received. So now in other words, we say everything that we're supposed to have received must be acknowledged as income because we have earned it. Remember, the word earn means something that you're supposed to have received but not yet received. So now we have credited rental income. Then what do we debit? We debit accrued income. We debit accrued income. And I think we know that accrued income is an asset. I highlighted that in the previous accrual basis video, 3,500. Now, the entry on the credit side goes to which financial statement? Under the statement of profit or loss. So now let us record this one first. Under the statement of profit or loss, we say plus 3,500. Why do we say plus 3,500? Because incomes increase on the credit side. That is where the incomes increase. So now we are increasing that rental income on the credit side by 3,500. Where do we record the 3.5? 3.5 is an accrued income. And accrued income is an asset. It's money that is supposed to be received, meaning it is receivable. So now anything that is not yet received, it is receivable. Receivable means not yet received. So anything that is receivable must go under trade and other receivables. So now we have to say here plus 3,500 rands in the statement of financial position under receivables. So we have now recorded the 3.5 of the receivable. So now that means in our adjustment, both the debit and credit is recorded, and we done and dusted never to come back to this adjustment. It's recorded in all the financial statements that were supposed to be recorded. Then we go to the second adjustment. Second adjustment, what does the second adjustment teaches us? The second adjustment is telling us that there is stationery on hand, meaning stationery that is not yet used. Remember, to those people who are working, you know, guys, that companies, they will buy pen and papers, not because they want to sell pen and papers. Maybe a company says they buy and sell motor vehicles, but they have pen and papers that are used for the administration of the business. We use the pen to sign the papers and the papers for administrative purposes. Now, that is what we call stationery. So now, the stationery that the company bought during the year, if you remember, the company bought stationery during the year, and this stationery was recorded as an expense, meaning it was recorded under the stationery expense account. So now, this is what was bought. But at the end of the year, they are telling us that the stationery that is left, which is worth 1,550, we bought 3,350 value or cost of stationery, but they are telling us that this is during the year. They are telling us that at the end of the year, we only have stationery that is 1,150. What happened to the rest? Obviously, the rest was used. The minute you use a stationery, that becomes stationery used, which is an expense. The minute you use a stationery, it becomes an expense. So now hence we say minus 1,550. So that the difference from what was available during the year becomes what was used. So now in other words, we'll have to say 3,350 minus 1,550. That means 1.8 will be the stationery that was used during the year. So now be mindful of that. Now, in other words, this stationery is an asset. It's an inventory left at the end of the year. That's my focus. It's inventory left at the end of the year. So we need to acknowledge any stationery that is left at the end of the year as an asset. Stationery on hand is an asset. Please be mindful of that. Stationery on hand is an asset. So now we need to acknowledge that there is an asset at the end of the year, which is stationery on hand. So now we are acknowledging stationery as an asset at the end of the year. We say there is stationery on hand or inventory of stationery 1,550. 1,550. Then after we credit stationery expense or stationery used. That is the reason why now I decided to change here and add the word stationery used. It was for this reason, because we need to identify the difference between an asset and an expense. And stationery used is an expense. So now we go to our adjustment once again, and we say we have stationery of 1,550, which is an asset. This is an asset, is on hand. This is an asset, right there, A, and this is an expense, that AXP, expense. Now, this is an asset. Asset, where do we record inventory? Inventory is recorded under the current assets as inventory. So now we record here 1,550. Then the entry on the debit side is recorded. The entry on the credit side is an expense, meaning we are decreasing our expense by the inventory that is left at the end of the year. So the 1,550 is the inventory that was left at the end of the year. So now we go to the statement and we say, out of the inventory that was bought during the year, what is left is 1,550. Why do we deduct what is left? Because we want to know what is used. We are saying we bought inventory worth 3,350 during the year, but what is left is 1,550. What happened to the rest? The rest was used. How much was used? It is 1,800 rands, which is 3,350 minus 1,550. We want to know how much is used, because we bought 3,350 and what is left is 1,550. Therefore, the difference will tell us that is inventory that was used during the year, which is an expense. The more you use a stationery, it becomes an expense. So that means now we have recorded both the debit and the credit for the second adjustment, and we are done, never to come back to this one. Then we go to the third adjustment now. Adjustment number 3 is telling us that commission income of 750 was earned. Remember the word earned. The word earned meaning it was supposed to be received. It's something that was due to us. So now, meaning we have commission of 750 that we supposed to have received, but we have not yet received. So let us look. Commission income of 750 was earned for April and May. So now, when is the end of the accounting period? The accounting period ends at the end of March. Do you see that? Although we have earned it, but it is outside of the accounting period. So now that means commission income 750 was earned for April and May. So now that means out of the, this case commission earned, it does not necessarily mean we have not received. It's something that we're supposed to have, it's something that was due to us. So now this will tell us that out of the commission where the out of the commission of 27,000, out of the commission of that 27,000, which we earned it, another one which is earned belongs to the month of April and May. So now that means the amount of 750 belongs in April and belongs in the month of May. And that is outside our accounting period, because we are doing the books for the year end 31st of March 2005. So now that means we have received 750, but that 750 belongs in the next accounting period. So now this will be income received in advance. If you remember that, this will be income that is received in advance. Received in advance. Money that is received before time. Now, please be mindful of the fact that the trial balance is for the year that ended 31st of March 2005. What does that mean? That means our accounting period ended 31st of March 2005, and we are required to prepare financial statements for the year that ended 31st of March. Take note of that. But we have received money for the month of April and May. So that means it is income that is received in advance. And we know that income received in advance is a liability. It's a liability. So now we record here, in other words, just to close the conclusion, in other words, the amount of 27,000 which is here is overstated. We were not supposed to receive 750. It was supposed to be recorded in the next accounting period. So now, in other words, we need to reduce the 27,000 by the 750 that belongs in the month of April and May, because our financial statements, income statement to be specific, must only reflect incomes for the current year. Now we need to decrease our commission now. Commission income. Remember, incomes decrease on the debit side. So now our commission income must decrease by 750. And we credit our liability, which is income received in advance. Income received in advance. And income received in advance is a liability. So this is a liability. So now liabilities, where do we record them? We record them in the statement of financial position under trade and other payables. This will be recorded as 750, income received in advance. The debit side is an income recorded in the statement of profit or loss. So that is where this gets to be recorded, and this will be decreasing our commission income. Why? Because incomes decrease on the debit side. There's no other entries regarding this two, I'm sure. They are done and dusted. So we have recorded the debit side in the income statement and the credit side in the statement of financial position. We received 750 for April and May, but our accounting period ends in March. So now that becomes income received before time, meaning it belongs in the next accounting period. Then now we continue on that same note to the next adjustment. The next adjustment, it is adjustment number 1.4. Only 4 adjustments left. Dr. D. Pesu disappeared. Management decided to write off his account to 2,650 off as irrecoverable. This is what we call a bad debt. What do we debit? We debit our bad debt. Remember, bad debt is an expense. So now our bad debts, meaning credit loss, I want to use the same term. Our bad debts, which we call them credit losses, are increasing. So this is increase in bad debts by 2,650. Then what do we credit? We credit our debtors because our debtors have to decrease. So we credit our debtors. We credit our debtors 2,650. So now this is credit loss and this is trade and other receivables. So let us start recording the credit side closer, where we are reducing our trade 2,650, trade and other receivables. We are reducing our debtors because this customer is no longer a debtor anymore. Why is no longer a debtor? Because he disappeared and is nowhere to be found. Then this will increase our credit losses or bad debts 2,650 by the end of the current year. So I think this will be the last one also regarding credit losses. So both the debit and the credit have been recorded in the financial statements. And guys, for every debit entry and for every credit entry, it goes to a specific financial statement. And always there must be debit and there must be credit. This go to the statement of profit or loss. This go to the statement of financial position. So, and for every debit and for every credit, if you do this, your financial statements will always balance, not sometimes, always, also in the next coming exam. Provision should still be made, number 1.5. Provision should still be made for depreciation on equipment at 10% per annum on the diminishing balance method. All the questions that I've went through in FAC 1502, the calculation of the depreciation is on the diminishing balance method. So master this is very easy. Cost minus accumulated depreciation times by the percentage or divide by the useful life. Now what do? We say cost of the equipment is how much? Cost of the equipment is 34,000 if I still remember. Even if I don't say it, cost was 34,000. Accumulated depreciation, it was 15,000 minus 15,000. Then whatever we get here, we multiply it by 10%. This will give us depreciation for the current year. We say 34,000 rands minus 15,000 rands times by 10%, which is 10 over 100, it is 1,900. So now what do? We debit our depreciation. Depreciation by 1,900, credit accumulated depreciation on equipment, how much? 1,900 rands. The entry on the debit side, which statement does it go? It goes to the statement of profit or loss. Why? Because depreciation is an expense. So this will be recorded under expenses. And I do have an expense of depreciation, 1,900. The entry on the credit side, where do we record it? In the statement of financial position, where the under property, plant and equipment, it will be negative, decreasing our property, plant and equipment. So let's go there and say under property, plant and equipment minus 1,900 rands. And I think this is the last entry to be accounted for. So I've recorded also this adjustment. Then we go to the next adjustment 1.6. Only two adjustments left. The water and electricity account for March amounting to 310 has not yet been paid. Has not yet. Remember, this is accrued. The word not yet means accrued. So now an expense that is not paid, it becomes an accrued expense. And accrued expense is a liability. So we know that this 310 will go under liabilities in the trade and other payables. We know that we need to say here plus 310. We already know that one because accrued expense is a liability. So guys, please master all these things. Master this very, very well. Make sure that you get 100% in the financial statements and other questions too. 100% is an easy thing in financial accounting. That I can guarantee you. I have students who have done it and you can also do it too. If they can, now you can. Now the water amount of 310, which is for the month of March, is accrued, meaning not yet paid. What does this mean? It means the amount of water and electricity that we see in the total balance that I'm still looking for. Where is the water and electricity? The amount, yes, the last one. The amount of water and electricity of 2,750 is less than it was supposed to be. We're supposed to say plus 310. We paid only 2,750. The 310 was not yet paid, but it was supposed to be paid. Therefore, it becomes accrued expense. Expense not yet paid. That means we need to add the 310. Why? Because it was supposed to be paid. Because it is for the current accounting period. So 310 is an accrued expense. That means our expenses, water and electricity, must be increasing in this case. So now what do we do? Remember, I said to you, accrued expense is a liability. So now we increase liabilities on the credit side, but we debit water and electricity. Water plus electricity. For how much? 310. Why do we increase this? Because the amount of 310 was not yet paid, but it was supposed to be paid because it belongs in the current year. They said that has not yet been paid. Hence I said that all expenses that we see in the total balance are the expenses already paid. So we paid 27,750 or 2,750, but we have not paid 310 for the month of March. So now that is very, very, very clear. Therefore now we say we're supposed to pay it, we debit it. Then it becomes accrued. We are saying now, because this is not yet paid, then it's a liability. Accrued expense is a liability, 310. So this will go to liabilities under current liabilities. This will go to the statement of profit or loss under expenses. So now we go straight there. We say under trade and other payables. There is 310. I've already recorded that one. And remember, liabilities increase on the credit side. Under water and electricity, I have to say plus 310 because this is an expense that was supposed to be paid. And this expense belongs in the current year. So we must increase our water and electricity because it is underestimated. Although 310 is not paid, we have the right to acknowledge it as an expense because accrual basis is teaching us that we must record expenses that were supposed to be paid. Meaning any expense that was incurred must be acknowledged as an expense in the statement of profit or loss. We are now approaching the end, even before the end of the hour. Approaching the end, and it says 1.7. That is where we are. 1.7 say that the insurance, now we are under the insurance. The insurance premium for April. Wait, for April. Our accounting period end when? End in March. So the minute we speak of April, no, it's not this accounting period, but we need to account for it. They say the insurance premium for April was paid in advance, meaning it was paid in March, but it's for April. The premiums are paid in equal monthly installments. Thank you for that one, because it aligned with what I've emphasized in the accrual basis video. Now they say the premiums are paid in equal monthly installments. That means our installments are the same, but we paid up to April. Remember, accounting period is ending in the month of March. Now, if we pay for April, that means now it becomes a total of 13 months. Now, if they wanted, they could have said insurance was paid for 13 months. They could have said that, but they decided to use the other dimension. So now we are very confident that the amount of the insurance that is in the trial balance is for 13 months. There is the insurance amount, and the insurance amount is 2,005 rands. Now we have to say 2,005 rands, 2,405, in fact 2,405 divided by 13. Then we can see that these monthly equal installments for insurance, it is 185. So now we can see that it is 185. So this 185 was paid for the month of April, and that will be prepaid expense, meaning expense paid before time. Prepaid expense or prepaid insurance expense. Prepaid expense is an asset. Prepaid expense is an asset. So now if it's an asset, it's always a current asset. That means it will go under trade and other receivables. 185 will be there. Prepaid expense is an asset. So if it's an asset, it will go under trade and other receivables. Then I will say, okay, we have already recorded this one because we know that a prepaid expense is an asset and it belongs under current assets, under trade and other receivables. Then after, what do we credit? We credit the expense that was prepaid, always. Similarly above, we said accrued on the credit side. What was debited? We debited the expense that was accrued, which was water and electricity. And previously there was another one. There was income received in advance. What did we debit? We debited the income that was received in advance, which was commission income. So it's always as easy as like that. The first one, we said debit accrued income, and we said accrued income is an asset, and we know that assets increase on the debit side. We debited accrued income. What was credited? It was the income that was accrued, which is rent income. So it's always as easy as like that. Now we have made clarity enough on that one. Then we credit our insurance. We credit our insurance for how much? 485 rands. 485 rands. Now this is prepaid expense, is an asset. We recorded it under current assets, under trade and other receivables. Insurance and expense. This is insurance expense. In other words, we are saying the insurance that we saw in the trial balance. Let me go there. The insurance that we saw in the trial balance, which is the insurance of 2,405. It includes insurance for the month of April, and meaning this insurance is including insurance for next year. We don't need that one, must be subtracted minus 185, because we only need to record expenses in the income statement that belong in the current year. So we need to remove that 185 because it is not for the current accounting period. So now that is the reason why we will go confidently under the income statement and we say under the insurance minus 185 rands. It will be added next year, not in the current year. Now that was number 1.7. The last one before the hour end. The last one says interest at 10%, at 10.5% per annum on the mortgage for the March 2005 should still be provided, meaning not yet provided for. Interest at 10%, 10.5% per annum on the mortgage for March should still be provided. That means there is interest for 1 month that is outstanding. That means the interest on the mortgage loan that we see in the trial balance is the interest that is paid only for 11 months. The interest on the mortgage loan, we see it there, it is 23,870. That means this amount of the interest is for 11 months. Let me prove it to you. 23,870 divided by 11. How much do we get? 2,170. That means interest per month is 2,170. So now if we have not paid for the month of March, meaning this is the amount of the interest that is accrued. Let me prove it to you. Let's go to the real calculations. How much is the mortgage loan? Our mortgage loan amount here, it is there. I can't even see it. Let me clear my writing. It is 248,000. There the mortgage loan, 248,000. Now we say 248,000 times by 10.5 divided by 100. We get to an amount of 26,040, meaning the interest for the full year is 26,040. Let me confidently go and record it before I do the general journal. 26,040, meaning interest on the mortgage loan total is supposed to be 26,040. If we say 26,040 minus 23,870, how much do we get? 2,170. Therefore, we say plus 2,170. And we're done with this part. So now this is just proving to you that the amount of 2,170 is really correct. which we have shown you there's 2,170 that is accrued. So now we can see that the amount that is accrued is 2,170, meaning interest not yet paid for the month of March 2005. So it becomes an accrued expense. And we know that accrued expense is a liability. Accrued expense is a liability. And liabilities increase on the credit side. So what do? We debit interest expense. Why do we debit interest expense by 2,170? Because the interest in the trial balance is shorting by 2,170. Why is it a shortage? Because the month of March interest has not yet been paid. Then after we credit accrued interest. Accrued interest is a liability, or accrued expense is a liability, 2,170. We recorded this one where we are increasing our interest expense. There is 2,170. We are done with that one. Then now we have to record accrued expense, which is a liability. All accrued expenses are trade and other payables item, 2,170. And we are done and dusted with that one. Now, the minute, guys, you are done with the adjustments, remember, you will not be explaining in the exam. The minute you are done with the last exercise, in 30 minutes, this question is done and dusted. The minute you are done with the last adjustment, then there's nothing to worry. What do we do from here? We go straight and we calculate. We go straight, quick, and we calculate, and we're done. Even if you can start here, that's not a problem. Let me do my calculations. 350,000 rands under PPE plus 34,000 rands minus 15,000 minus 1,900. Then this will give us 367,100. Draw a line there. 367,100. Then we don't have any other item, 1,550 of inventory. Then also under bank, we don't have any other. We have 224,208. Under trade and other, 1,550, just to be on the same line. Then we do the calculation immediately. 26,100 plus 3.5 plus 185 minus 2,650. We get straight to 27,135. 27,135 plus 1,550 plus 24,208. We get 52,893. 52,893 plus 367,100. We get 419,000 total assets. 419,993. We're done with the assets. Equity, we're still waiting for the profit here, if it's a profit, or minus if it's a loss. Under long-term loan, there was no repayment, 248,000. And after, we go straight to 750 plus 310 plus 2170. We have 3,230. 3,230. Then this will give us total liabilities at the bottom. Now we go to the income statement 1212. We're done also. Check if it will balance. 64,000 plus 3.5 equals 67,500 2,700 minus 750, 1,950. Then we have our total incomes plus 67,500, which is 69,000, or we can write there on top 69,450, 69,450. Even if we write it at the bottom, then it must be on top so that we write expenses here correctly. My total expenses, we have 4,333. Another one is 1.6 plus 2,650, which is 4,250. Then we have insurance, which is 2,405 minus 185, that was paid for April. We have 2,220. I prefer to write them in brackets, although I said minus or less expenses. 2,220. We have water and electricity 2,750 plus 310. We get to 3,060. Depreciation 1.9. Then we add all of them, plus 1.9 plus 3,220 plus 4,333 plus 2,640 plus 4,250 plus 1.8. We get 43,603. We get 43,603. Still negative. Throw a line there in between or across. Then we say minus 69,450. But remember, for me, I know that is still a profit, even if I deducted the big one from the small one, or the small one from the big one. 25,847. Then we have other comprehensive income for the year. This is revaluation. We don't have revaluation. Then after we have total comprehensive. Comprehensive income for the year, which is the same 25,847. So this amount is the one that go to the statement of financial position under equity capital, plus 25,847. Then we start saying minus 149,000, both the sign is negative, plus 6,084. Then this gives me 168,763. 168,763. Remember, what I've said, 149,000 minus 6,084 plus 25,847, just to see the clear calculations. So now we need to say plus our 248,000 long-term loan, plus 3,230 of the trade and other payables. We get to a total of 419,993. If this figure is the same as that figure, you get excited to jump in the exam and to scream. They won't take you out. You say because you're mastering what you're doing. Then after we have our total equity and liabilities. Total equity and liabilities. There is no space there. But our financial statements, they are balancing. Remember, you can be required to do the statement of changes in equity, where now you need to show this in the statement separately, and the total of that will be this amount at the end of the day. This will be opening balance when you do the statement of change in equity. This will be drawings, less drawings. If there was capital that was contributed by the owner during the year, you'll have to say plus capital contribution. Then if it's a profit that is from the income statement, then we add this profit. If it's a loss, make sure that you acknowledge the loss as negative under equity. With that, guys, you've been lovely. This question is very useful for the 2020 assignment 2 of semester 1. Thank you very much. Be lovely and be good. Don't forget to subscribe in my website. My website is unlockaccounting.co.za. You only subscribe for a lousy 450 to access all the resources that I have for you for this subject for the entire 6 months or for the entire semester. So you get a lot of resources. Only 450 is a once-off payment for you to access only for this subject. Every subject you pay 450. Please, guys, subscribe, support what I do by subscribing and trying to get a small amount of 450. And you pay that 450. If you encounter any problems, click on that WhatsApp link, then you'll get to WhatsApp me through the website. Then it will direct you to my WhatsApp number. Thank you guys very much. You've been wonderful audience once again. I love you very much. God be with you. Thank you.